Hi everyone, this is Alan Rosenfield with Harmony Asset Management, and this is our latest edition of Thoughts and Comments, our thoughts going into 2021. I've been trying to say that this is going to be a short video, and I've done it 8 times and it's always been over 10 minutes, so I'm trying again because I tend to wander, but there are only a few points that we really need to talk about that are important here. We've been saying for a year the markets have been getting speculative and frothy. They're even more so now. Let's do a quick review. Let's look at 2 charts just to give you some backdrop. This first chart is unemployment. Notice it's still well below where we were. Employment levels are much lower than they were in 2019. The second chart is comparing the GDP in the US using the left axis versus the S&P 500 on the right axis. Take a second and study this. What you'll notice is that GDP is off by $1 trillion from a year ago, while the S&P 500 is at all-time highs. So the economy has not recovered, yet the stock market's hitting all-time highs. We've said before this is highly speculative. Let's look at new data to prove it even more. What's basically been happening is that people playing in the markets have moved even further out the risk curve. One of the things we can see to prove this is looking at IPOs. Volume on IPOs in 2020 hit all-time highs. The IPO market outperformed the S&P by almost a factor of 7, with more than half of the companies going public, not even earning a profit. And of all of these IPOs, 45% of them are SPACs, special purpose acquisition companies, which are basically blind pools where you give somebody the money and say, I'm going to go find something to invest it in. You can't get much more speculative than that. The fact that the volumes and the amounts are so high is big proof that we are very speculative right now. The second thing we look at that leads to a lot of speculation is what's happened this last week with GameStop. GME moved from $4 a share in September to over $350 in the last 2 days. It's up over 1,600%. Yet, this is a company that's busy dying. It's going out of business. Now, maybe they'll change their business model. Maybe they'll be able to fix it. But the fact of the matter is, they haven't done it, yet people have paid huge amounts of money. This is massive speculation. It wasn't bet on a long-term investment. It was a bet on a way to squeeze hedge funds that were short and make a quick profit. Now, I don't have any problem with beating up on a hedge fund unless you're manipulating the markets. And I think there's a good chance there was manipulation here. But it's just as wrong as when the hedge funds manipulate markets, and they do it as well. But bottom line is, this is not investing. And that's dangerous. Interest rates are rising. Look at this next chart. This is the yield curve currently and 6 months ago and a year ago. And the important thing here to pick up is not that interest rates are high, because they're not. It's that the spreads between the short end of the curve and the long end of the curve are widening. Now, that's not bad in a normal economic scenario, but when you have as much debt as we do, that becomes very dangerous. Why is it happening? One, because the government's been borrowing so much money and they're about to do even more, and therefore they've got to sell debt, and there are fewer people interested in buying that debt. The second thing is that the dollar is starting to get weaker again. Now, this next chart brings up the long-term 20-year movement of the dollar versus a basket of other currencies and comparing it to gold, which is a way to compare something that tends to trade opposite or the inverse of when the dollar is strong. So you can see the dollar was much stronger 20 years ago. It's come way down. It's done some rallying since then and given it back, and it's doing some short-term rallies. This is due to the debt all the other countries are producing, but in the long run, the US dollar is likely to go down. with that happening and interest rates rising, it kind of reinforces itself. So you've got a lot of risk, and you've got winds that are blowing in your face, making it harder to make money without just speculating. So what are we going to do about it? There are actually a couple of things that we're fairly excited by. Number one, we think that interest rates are going to continue to go up. So where before we were much more heavily invested in bonds, we've been reducing our bond positions for almost 5 months now. Number two, if you look at this next chart, this compares the emerging markets, which is everything but the US basically, so in Europe and in Asia and in South and Central America, the smaller countries, not the larger economies, but they have not moved in quite some time. Notice they haven't broken to new highs at all, while the S&P is at all-time highs. What that means is that PEs are much lower there relative to the US. And I think that we're starting to see a change. We're starting to see a change from the large cap stocks to smaller cap stocks. We're seeing a change I think we'll see going from the US to international companies. And I think that's because as the economy worldwide gets better, which it will as we get through COVID, as vaccinations get out there, other countries have not grown like the US has. So I think, relatively speaking, other places will grow faster than the US. And so we think the international markets could be very interesting. The next place that ties to that is the commodities markets. Now, we're not saying that people should go start trading commodities in the futures markets, but we think there are ways to buy basic metals, industrial metals, agricultural products that will again benefit from a global expansion as people come out of COVID and as the dollar gets weak. So those all tie together. And then finally, we think that the banks could have an interesting play because they make money on bigger spreads. They borrow at a low rate and they lend money at higher rates. We think there's an opportunity potentially there as well. So there are places to play. What's most important is that we continue to diversify and leaves ourselves with plenty of cash for protection, because when and if these markets sell off, they will do it very rapidly and you won't have much time to get out. So you've got to be defensive in nature and be buying things that are out of favor, moving to places that everybody else isn't looking. I hope this was helpful. I hope you found it enjoyable. If you did, please hit the like button and make sure to follow us. And if you have questions, always feel free to reach out to us. Look forward to answering any and all your questions. Thanks again for listening. Bye.